Welcome back. Welcome to module 14, strategies, future strategies. Till now we have seen what is derivatives, we have seen what is futures, options and forwards. From now on we will see how various strategies can be built in. First we will start with future strategies. So as always, our LinkedIn profile, YouTube profile and our website details, contact details, phone number, everything is given. So target audience, same, MBA, CA, CFA students, intraday traders, anybody who is interested, definitely they have to watch this, because having a sound knowledge and good understanding of concept will help you make a better trade. Takeaways. What is the takeaway? Good understanding of futures, covered strategies using futures, lastly dramatic transformation in investor traders confidence levels. Let's straight away jump in. Covered strategies, stock futures, key requirements. I have given a 4-step key requirements that are there to adopt a cover strategy. So what is it? Stock should be traded in F&O. First, it is stock futures. It is not the index futures, stock futures. Hence, the stock should be traded in F&O segment. This is more from an Indian concept. Globally also the same concept is applicable. First and foremost, the stock should be traded in F&O. If it is yes, then quantity of shares applicable in a market lot. So like for example, in Indian context, many companies will have one market lot, some companies will have 200, 250, 1000, 1500, so on and so forth. So hence, look out for the quantity of shares in a particular market lot for that company. Then sufficient funds in your bank account to buy those quantity of shares. We will explain in detail. Okay. Lastly, if you were to sell, quantity of shares should be in your demat account. That is the sufficient quantities to sell a market lot. These are the pre-requirements or preconditions for doing a covered strategy in futures. So let us go. As you can see in slide 5, I have put here buy. So what you do is that I tell people, if you have sufficient money, assuming that they have met the first 3 conditions for buying. So instead of buying a stock in cash, just buy in futures. What is the way, how it works? So what happens? You buy a future, stock in futures. Okay. So there are 2 outcomes that will happen. As we have seen, derivatives itself is a contract. That means it expires over a particular time period. That means let's say we are in January now, it expires by the end of this month. You enter January 2023 contract. So it expires by the end of this month. At the end of the month, what will happen? There are 2 scenarios that will happen. Of course, from here till the end of the month, anytime you can enter or exit. We are talking of here adopting a covered strategy, buying a futures instead of buying a stock. So how it works? Hence, assuming that you hold the futures position till the contract expires. There are 2 outcomes that will be possible. One is that you exit with a loss. You incur a loss. So what you do? In loss, you exit with a loss and then you don't do anything on the futures. Leave it. In the futures you incurred a loss, it's fine. Or you exit with a loss and also take delivery of the stock in futures, because after all your intention was to buy that stock. Instead of buying in cash, you are buying in futures. So hence it is a good strategy. Suppose you are in a profit. We will give with examples down the line. If you are in a profit, exit futures with profit, and also you can take delivery of the stock if you want. So these are the 2 strategies, either loss or profit. In the case of sell, obviously as I given here, implementable only when shares in demat account is sufficient to sell one lot, which I gave in the precursor earlier. Instead of selling in cash cash market, you sell in futures. So but the precondition, you should have it is better because it is a covered strategy. You should have the sufficient quantity in your demat account. Assuming you are having, you will have here again 2 scenarios, profit and loss. If it is loss in futures, exit futures with loss and don't do anything, or exit futures in loss and also give delivery of the shares that you already own, right? In the case of profit, it is the same thing. Exit futures with profit or exit futures with profit and also give delivery of stocks. These are the 2 ways of working out. Now let's go to slide 6, where you can see the pictorially I have given an example. So I will read out. On February 1, 2015, an investor Z buys one lot of ABC company. 250 shares is the quantity of shares in one lot. At rupees 2400 per lot, he bought only one lot, expiring on 31st March 2015. This is some old 7-year story. Okay. So what happened? The contract value here once again, this 31st March, my humble request to everyone, whoever is seeing the video, don't go into the logic of whether 31st March was a working day or Saturday, Sunday, holiday. Here we are explaining the concept. So these dates, whether that date expired or not, is trivial things. Let's not worry about it. We will understand the concept. So the expiry date is 31st March 2015. Contract value, what is contract value? It is 6 lakhs. What is 6 lakhs? 250 into 2400. That is the futures we bought. So now, two scenarios straight away. Loss, which I have shown on the left hand side, maroon color. Profit on the right hand side, white and green shaded. Right? Loss. Suppose on the settlement day, that is the expiry day, 31st March, settlement day, the settlement price is 2250. So what price we bought? 2400. We thought price will go up. So price didn't go up. So 2250 is the settlement price. Now on settlement day, we have to compulsorily incur loss because exchange will debit our account for that amount, and we have to exit with a loss. That is compulsory. So loss of 37,500 we have to book. No choice. Why? The loss is 2400 minus 2250, 150 into 250. Right? So which I have shown in the extreme left hand corner. 37,500 loss. And also we can decide, because our intention was to buy the stocks. This person's intention on that day was to buy the stock. Hence, what she decided was incur the loss in futures and also take delivery of the shares. So taking delivery, what happened? She has to pay how much? 5,62,500. Why 5,62,500? The settlement price is 2250. 2250 into 250, which is 5,62,500. So she buys this 250 shares by paying 5,62,500, 2,250 per share. Assuming that another person on the same day, he had incurred a profit. The settlement price, assuming that this same transaction ended in a profit. So 2475. Okay, assuming that instead of loss, it had closed in 2475 on settlement day. That is on 31st March 2015. So what she could have done? She could have exited. Of course, she has to exit with profit. No choice on that. 18,750 is the profit in futures. How? 75 rupees. 2,400, 2,475 minus 2,400. On the right hand side you can see into 250. That is the profit. No choice on that. Second is that she can take delivery of the shares also. But how much she will be paying? 2475 into 250. That is 6,18,750. As you can see clearly here, if futures she would have made a loss, her buy price is lower. In futures, if she had made a profit, her buy price is higher, right? So overall, her intention was to buy the shares. So if she has sufficient money, as I mentioned in slide 3, again I am going to slide 4, sorry. If the intention was, as you can see, sufficient funds to buy these stocks, third point, step 3 in slide 4. Okay, so you can buy the shares, simple. So instead of buying in cash, you buy the shares in futures. So that way you can make money. Or if you lose also, anyway your intention was to buy the shares. So you are buying the shares at a lower price. On derivatives, which anyway we will discuss in income tax on derivatives, it is a trading income. So you can show it as a loss. So whichever way you can work out strategically. That is why we call it as a strategy. Now this has happened on 2015. Come 2021. Okay, slide 7. On October 21, 2021, this person now finds the shares of ABC at 7,300. So now she thinks that I am not sure whether the price will go up or whether it will come down. Hence, no, I am undecided. But at the same time, it's a good company stock. I don't want to let go the shares that easily. But at the same time, I want to do something. Instead of keeping the shares idle, in like how it earns dividend, one can play on derivatives. This is what covered strategy. How? 1st October 2001, she sells futures, one lot of futures. Again, go to slide 4. Once again, I am going to slide 4 to sell quantity of shares in demat account, that should be equivalent to the market lot. So because she bought in the market lot, she has in the market lot, right? So now as you can see here, 7,300 per lot she sells, expiring 25th November 2021. Two scenarios here again. She is selling at 7,300, thinking that the price will go down. Suppose the price goes up 7,500. Settlement happens on 25th November at 7,500. What happens? Two things. One, you have to exit the futures with a loss. No choice on that. So what is the loss? 50,000 rupees. How? 200 into 250. How is that 250? 7,500 minus 7,300 into 250. 200 rupees is the difference, loss, right? So, and also retain the shares. That is one option. Or take the loss and give this 250 shares. Anyway, she was undecided. She was not sure whether it will further go up, and she is in need of money. She can do that, or she wants to retain the shares. She can retain that. So the choice is there. Now let us assume, go to the right hand side. Profit. She thought that the price will go down. Here, what she does? She, on the settlement day, the price is 7125. Assuming she has sold at 7,300. Now the price has come down 7125. Okay. So now she is making a profit of 43,750. How? 175 into that 175 is from the difference between 7,300 and 7125 into 250. So that is the profit that she earns on the derivatives transaction, and she has now the choice. She can retain the shares, or she can get the profit and also give delivery of the stocks. So by giving delivery of stocks, what happens? She is getting 17,81,250, whereas in the earlier case she is getting a higher price of 18,75,000. So in the first case, when she incurred a loss in derivatives, her long-term capital gains will come down, and also her long-term capital profit increases, but tax will come down, because long-term capital gains is taxed at 10% now, at least on this day, okay, January 2023. So, and whereas in the second scenario, though she has incurred a profit in derivatives, her long-term capital gains will slightly come down. So hence it is a trade-off. So this is why I call traders can adopt any strategy that suits, but they have to do in a structured and systematic manner. That is why this is very, very important. So now, once again we will see what are the uses of derivatives. Now that we have seen this example, I am sure you would have got a thorough understanding of how futures can be used as a strategy. Instead of blindly selling a naked futures where you incur a loss, you can strategize and make systematic, consistent money in a systematic fashion. So uses of derivatives, we have discussed many times. Lock-in prices, particularly a company which is receiving foreign exchange, they can lock in the prices, or farmers. Hedging, just now I gave the example. You have stocks in your portfolio that you can hedge by playing in derivatives, and instead of stocks being idle, you can earn money on it, in the futures money, because you need not worry. Even if it is loss, anyway it is a loss on the profit, right? If you are a profit on futures, still fine. Anyway, you want to be associated with the company. So you can play beautifully by hedging. This is a very good example of hedging. And mitigating risk. This again useful for risk mitigation. Arbitrage, which we have many times told, it is between two markets, or you're taking advantage of the price difference between two markets, right? Speculation, as always I have told, it is betting. Okay, so God only can save people who are speculating without having sound knowledge. But derivatives are tremendously useful. It is very good instrument for managing your risk, hedging and portfolio management. With this, thank you very much.